Well, welcome to Dairy Livestream. I'm your host, Corey Geiger, managing editor of Horde's Dairyman. We are broadcasting from the Cheese Cave here in downtown Fort Atkinson at the historic W.D. Horde & Sons Company building, commissioned by Wisconsin Governor W.D. Horde. What will the markets have in store for milk prices? That's the most pressing question for the upcoming year for those of us who milk cows for a living. Today's guests will help us navigate those waters in the Dairy Livestream webcast we've titled, Taking a Position on Milk Prices. Some rather candid comments were given on the topic at last week's virtual meeting of the National Milk Producers Federation, Dairy Management, Inc., and the U.S. Dairy Export Council. Quote, "We have to look at every way to forward contract in our business," said Randy Mooney, president of the National Milk Producers Federation and an Arkansas dairyman and board president of that organization. "We just started sign up for the 2021 Dairy Margin Coverage Program," said National Milk Producers economist Peter Vitaliano. Quote, "As we saw last year, we did not expect that the program was going to make payments, and it made major payments. It's an insurance program," he reminded the audience that day of DMC. "You can't really trust the forecast in a pandemic. We urge all dairy producers to sign up for dairy margin coverage if you have not already done so, up to the $9.50 level for your first 5 million pounds of milk," continued Vitaliano. Speaking of the Dairy Margin Coverage Program, that program has the thumbprint of Representative and House Ranking Ag Committee member Chair Colin Peterson out of Minnesota. Last night, he lost his bid for re-election. That will leave a void in agriculture. He really understood the issues and was the principal person, the leader of the group that helped usher the last 3 farm bills through Congress, and really had the ears of other leadership on both sides of the aisle in this era that's a bit challenging politically and a bit heated. So we're going to open it up to our panelists here. We're going to go to a poll question, and we're going to talk about dairy margin coverage right away. In 2019, 23,000 dairy farmers signed up for DMC. How many signed up in 2020? Your choices are 3,000, 13,000, 23,000, and 33,000. So go ahead and vote. For those of you who are watching on computers with a screen, you can vote. Those of you, I know we have people listening in podcasts, earbuds, and their phones, so they won't be able to vote if you're in listen-only mode. So we're over 60% voted here. We got 2 leading candidates here for that answer. Let's go ahead and close the polls here. The correct answer is 13,000, so 10,000 fewer dairy farmers signed up for DMC. Of course, DMC, or Dairy Margin Coverage Program, is just one of the many risk mitigation programs available to dairy farmers. To share more on the topic, we invite our first guest to Dairy Livestream. Tiffany La Mendola has been examining and providing strategic perspective on dairy markets for over 2 decades now. After graduating from the University of California, Davis, La Mendola served as Director of Economic Analysis for the Western United Dairyman, which is a trade organization that represents 60% of the milk produced in California. These days, La Mendola serves as Vice President of Risk Management for Blimling and Associates. Tiffany, you've been helping dairy farmers implement milk price mitigation strategies for 2 decades. What's your advice to help us navigate the 2021 milk price year in the face of this continuing pandemic?
Yeah, thanks very much for having me this morning. Fun topics for sure. I think there's one thing we can all agree on about 2021 is there is really still a lot of uncertainty around milk price prospects, right? So that alone, I think, should be encouraging producers to be taking a long, hard look at what we can do to reduce volatility, protect margins, or just simply take some downside price risk off the table. Or just zooming back, really, good practices would tell us that, producers thinking about risk management should be thinking, continuingly, a quarter to 2 quarters to 3 quarters ahead. And certainly the markets right now, particularly in the class 3 space, are offering some really good levels. Q1 is sitting about $2 above the 5-year historical average. and Q2 about $1.25. So combine that with all the uncertainty, and I think there's some really great things to look at. In our experience, we have found that producers have really long time been very comfortable in managing the feed side of the equation in their margins, but maybe a smaller proportion on the milk side of the equation. I think, though, that we can talk about some tools today that have been really exciting in ushering in some more participation to this space, and certainly can hear from some, firsthand accounts on that. There are a lot of tools. Some of them have been around a really long time. Obviously, producers can open up their own brokerage account and access futures and options that way, or via mini forward contracting programs across the U.S., they can access similar tools. There's also over-the-counter type tools available offered by banking institutions and the like that are also similar to those futures and options types contracts. Of course, LGM Dairy has been around a long time, but I'd like to hone in on a couple other programs. Already mentioned DMC to great length, the Dairy Margin Coverage Program, and also DRP, Dairy Revenue Protection. And I kind of focus in on those because I think that's where we've really seen some exciting uptake in the risk management space. It has, there's been some improvements to DMC, and DRP is a relatively new program. On DMC first, as Corey mentioned, pretty good uptake. For 2020, we estimate about 51% of the operations or 13% of the milk signed up for 2020. And we suspect the numbers will hopefully look a little even better for next year. This program does all the work for you. It is a margin protection program with both feed and milk part of the equation. And if you're a herd under 225 cows, it does it all for you. It's a no-brainer. 5 million pounds of milk a year at a $9.50 margin, you're set. If you are bigger than that, then you probably will need to look at some supplemental tools alongside of DMC. But as Corey mentioned, sign up. It's $7,500 to get that protection for the year, and estimates already show the program most likely with some payouts for next year. Moving on to Dairy Revenue Protection Program, that has definitely filled in some gaps. I think the most exciting thing is that a large proportion of folks we've worked with are either new to the dairy risk management or milk price risk management space, or they're people that have tried things in the past, it didn't sit well with them, and they gave up, and they haven't been doing anything since. So a lot of new entrants, and by estimations, it's about 25 to 30% of the U.S. milk has participated in the program in some form or fashion. So really big uptake for a relatively new program. And, I think kudos to the authors. There were a few things done to address some of the obstacles and hurdles that producers have faced over the years. One is it's the equivalent of a milk price floor. It leaves all the upside open, which is great for those that worry about that. I think you're going to hear from Bill that, obviously margins should always be your focus, but there are some that, have a hard time leaving that upside off the table. The program's very subsidized, meaning you can buy equivalent coverage for downside price risk for almost half the cost as you could in your own brokerage account. It's scale neutral. It doesn't matter if you have 50 cows or 50,000 cows, you're going to find it's the same per hundredweight price in your region. It's totally customizable. So obviously the object of milk risk management should be to employ tools that best mimic how your milk price is determined. So if you're in an area with both class 3 and class 4 utilization, this program lets you customize your coverage so you're adequately covering all of your milk price risk. Also, if you're high component, there's options as well. And honestly, it really is pretty simple. If you take some time to understand the program, I think you'll find it's easy to access. So without diving into, a lot of the details, there's great tools. The year ahead is uncertain. I encourage everybody to give these a hard look, reach out for help. Folks with dairy expertise can talk you through these. You really, there will be something out there that you can feel comfortable with. I'm confident.
And Tiffany, thank you. Don't let that word, listeners, the word subsidize scare you on that either. You know, the way these programs were written, Dairy Margin Coverage Program and Dairy Revenue Protection, congressional leaders wanted dairy farmers to put some skin in the game to help themselves. And so that's how these programs are been written, and they're there to help you. So don't ever listen to someone from outside of agriculture say, oh, you're being subsidized. No, you got to put skin in the game to use these programs. It's no different than buying insurance if you're in a floodplain and got a house sitting on one of the eastern or western seaboards. Tiffany, a little bit of fun banter here. We definitely have some deer hunters that are watching the program. We got a couple of questions in, and they wanted to know if those deer mounts were yours. And the answer is,
I wish. They're my husband's, but I do support him in his adventures.
I'm personally jealous because I only have one in my house. But with that, we will go to our next poll question here. How much assistance have dairy farmers received from CFAP? That's the Coronavirus Food Assistance Program. And the answer choices here are 155 million, 255 million, 1.55 billion, or 2.55 billion. And there's a reason go ahead and answer that. There's a reason we're asking that question, because as we look at price mitigation risk strategies moving forward this year, I think we got to be really cognizant that there's revenue coming to dairy farms here that is unusual this year, and that may not happen in 2021 and probably likely will not. So we have just at 50% voted here. We're going to cut that off. The correct answer starts with the word B, billion. And right now it's 1.55 billion. And as those payments expire, the University of Missouri Scott Brown predicts that total dairy farm income next year could drop by 3 billion, or nearly 7%. Dairy farmers need to prepare for that situation. That's why we're having this DairyLivestream webcast today. And I'm very excited to have Bill Marvin with us today. He's been implementing milk price mitigation strategies on a Sunny Dean dairy in Washington State for a number of years now. I look forward to hearing from this articulate veterinarian and dairyman who will share his practical perspective on what dairymen and dairywomen can do to better protect their milk checks moving forward into 2021 as this pandemic continues to create turbulent dairy markets. And we've seen swings on all ends on cheese. It was down to $1 and pushed up to $3. Bill, talk about what you're going to be doing this coming year.
Thanks, Corey. Glad to be here and have really appreciated this whole series of webinars. I think it is a great service to the industry on a number of topics, and I appreciate the invitation today. I think as Tiffany's able discussion pointed out, there are lots of options on how to stabilize the future of your business. I think I want to spend a little time on the why rather than the how, and acknowledge that risk tolerance is a very personal decision. I think it's a mistake to look at any of these risk management tools as price enhancement tools. We look at them as stabilizers rather than price enhancement. It can work both ways. And why do we do it? Once you come to conclusion that you want to stabilize the future of your business, there are companies like Tiffany's and others that are very capable of the education and the assistance that you'll need to get through it. Lots of tools out there that weren't there when we started. It's really a very fertile ground now for those who become committed to it. So why do we do it? We wake up with sort of a dual mandate every day. We really like the dairy business, so we want to stay in it. So one mandate is figure out a way to manage our business that we survive the volatility that is inherently part of agriculture, any commodity really. And Tiffany made the argument, but those of us who are in the producer sector know what I sort of refer to it as a Jekyll and Hyde business. In the last 7 months, we've seen both $10 and $25. If you look forward into 21, I think today's uncertainty in the world around us relative to policy and economy and pandemic are a pretty strong argument that anybody who thinks they can venture a guess as to next August milk price within $5, good luck with that. So risk management is a way for us to look forward and stabilize our business. We've been in it about 30 years and discovered early on that it is quite possible to work hard all year and end up with nothing or less than nothing. And again, the personal part of this for us is that is not okay with me. We didn't come from that. I'm 31 years new to agriculture, and that sort of volatility does not make me an effective manager of operational excellence when I have no idea whether my work will turn into something fruitful or not. So we must have visibility into the future to retain our sort of management acuity to execute an excellent plan. If we're distracted by wild gyrations in future milk price or future feed cost, we become less effective decision makers. And I certainly see this in our own operation, and I have seen it in producers I work for who are very capable managers, but sometimes make more marginal decisions playing defense during periods of difficult pricing cycles. And I would say this, and this is less intuitive, that I've also seen people make bad decisions during wildly profitable times. There's certain sort of, I call it the invincibility syndrome, that causes us to adopt costs in our system or personal toys that are costs that we then need to live with through the next part of the cycle. It seems at some point like that will be easy, and then it becomes difficult to meet your obligations under those new investments. We can invest with more confidence when we can see the future, and we can execute more effectively when we can see the future. And I want to emphasize that for us, that means margin more than it means milk price. So we look at either fixing milk price or fixing feed cost as sort of a half of a hedge, and probably believe that a half of a hedge can be more dangerous than none at all, because price of feed and price of milk tend to be correlated over longer periods of time, but very dangerous over short periods of time. So when we talk about taking a position, it is taking a position in margin rather than taking a position in either price or cost alone. And we just have excellent help in that regard. A little shout out to a guy by the name of Jim Kelly, who we work with. We have a risk committee that meets every Tuesday. It is the most important thing on our agenda for the week. It consists of 2 members of our team on the farm, and then 1 member of what we consider to be our team in Chicago. And we look at opportunities in margin out 15 or 18 months. And you know, it can be frustrating at the bottom of the cycle to not find opportunities that meet your objectives. But I would argue that if you're watching out into the future, I have never, almost never at least, seen a contract during its entire life, from the time it first hits the board to the time that is settled, that hasn't represented an opportunity for us to protect our ability to stay in business. So there's 2 regrets in managing stability. One is I missed the last $3. You know, that's sort of a strange feeling, but usually it results in a position where we're profitable, just not as profitable as we could have been. The alternative for us is to miss the price by $3 the other way because we did nothing. And the reason we think that's a worse outcome is that may leave us unprofitable. So locking a price that's profitable only leaves the small risk of leaving a little money on the table rather than exposing you to the large risk of these significant backdrafts that we have seen in our industry that have taken out generations of wealth in 1 year. So I'll be happy to answer questions about the how. That is our version of why. We're 22 years into using futures and options, forward contracts, DRP, DMC. They're all useful. They all fit different crowds, but we like seeing the future. We think it makes us better operators. Happy to discuss that.
Thank you, Bill. And my brother-in-law is putting in new robots right now on his third set after been with robots for 20 years, but he's not only using DMC, but we together went in and worked on dairy revenue protection and added that into the portfolio. And as he continues to grow his business, that's right. You want to be ready for the next generation and be successful in this generation too, from the wealth standpoint. Before we go to Chris Wolf, our third guest, let's go to a final poll question. The influence of government money could account for what % of farm income in 2020? The choices are 16%, 36%, 56%, or 76%. The source of this answer is University of Missouri's Food and Agricultural Policy Research Institute, FAPRI. And FAPRI is one of the organizations that does a lot of work behind the scenes for the House Committee on Agriculture and the Senate Ag Committee on Agriculture as they develop policy. So we're over 50% voted here, and people are doing really well on this one here. I'm very impressed on this matter. And so, Jim, I would encourage you to go ahead and close this poll on this one. And the right answer is 36%. So 61% of you got that answer right. And this is going to lead into Chris's discussion here. Again, you know, this year's farm finances, as you work on the numbers for 2020, might look pretty good. But there might be a false sense of bravado here with some of the pandemic spending here from the federal government. Chris, you spend a lot of time on this topic as an economist. Indeed, 2021 could start out facing similar conditions we've been dealing with since COVID-19 first arrived in the United States. So talk about 2020 and what 2021 might look like on the milk prices and the bigger picture of farm finance.
Thanks, Corey. Happy to be here again. I would encourage, it's been great listening to Tiffany and Bill here. I think lots of good advice. And when I kind of sit back and look at milk prices and try to put my producer hat on and think about it from that point of view, I like to think about milk price opportunities and milk pricing at farm level from three different dimensions: stability, predictability, and adequacy. Okay, and I think that when we were looking at the next and I think lots of good advice from Bill and Tiffany. I would encourage you to be looking 6 to 15 months out for opportunities. And you can have stability without adequacy. For example, think about 2002, 2003 when we were sitting near support for 18 months. Right, it was very stable and predictable, but it was not adequate for a lot of farmers. And similarly, you can have predictability without it being adequate. So you kind of want all three of those things. And right now we're in a situation with the economic uncertainty caused by the COVID pandemic that Corey mentioned, by the government expenditures that are unlikely to continue at the current levels, into the future. Think about the demand and income impacts as if we have to shut down more, or if unemployment expenditures go down because there's no stimulus there. And we also have the impact of international trade, right? So we're looking at the U.S. Milk production was up 2% last month. That's pretty decent increase. Europe has also been seeing some increases, and all those things are going to trickle through and matter, and all sources of uncertainty here and affecting stability. We're thinking about predictability. it seems like every time we start to get a handle on, basis, thinking about the difference between your mailbox price, right, and say class 3 or 4, whatever you're using, generally class 3, but now with Dairy RP, as Tiffany said, you've got more opportunities in 4. But, this negative PPDs that we've been seeing under the pandemic have made us realize that that change from the higher of class 3 or 4 to the average plus 74 cents makes a big difference when we've got a spread in class 3 and class 4 milk prices. And going into 2021, well, actually, this month, about $8 spread for this next month, $10 for the month after that. And so that's going to exacerbate that issue. And, the markets are thinking that maybe that comes together in 2021. And there's some reasons to think in the longer term that it needs to, right? But that kind of matters. And, depooling is another source that we haven't had to deal with at these levels in the past. And then adequacy, to me, that's really very much about the stuff that Bill was talking about at the farm level. What's your cost of production? What's your variable costs? What are your cash costs? What are your total economic costs? Because as Bill so eloquently said, you shouldn't be working all year long for nothing. You've got your unpaid management, labor, and capital that need to be earning money, and understanding your general financial position as far as your liquidity position, your solvency, and are you near danger thresholds in those dimensions. That would, to me, indicate that you should be paying even more attention to the risk management opportunities. And then let me just kind of finish up my comments here by noting that we're focusing, rightly so, I think, on milk price here, but there's also feed issues, right? Everybody's buying some feed concentrates of some sort, definitely, and maybe some farms are buying more than others. So you're looking for feed pricing opportunities. We've been seeing feed costs going up. If you look at the dairy margin coverage for 2021, keep in mind that as feed costs go up, the likelihood of payments there also go up. And, if we had a year like a 2012 where feed prices got, really spiked, and that would definitely impacts payments there. And also, this is the time of year at the beginning of November when I would encourage all dairy farmers to be thinking about pre-tax planning, getting a handle on what your tax bill might look like for 2020. These CFAP payments, the DMC payments, these other things like that are taxable income. And so, the part of the question might be, do I want to prepay some feed or seed or fertilizer or something of that nature to manage my tax bill going on this next year? So I'll just kind of wrap it up there, Corey, and looking forward to the discussion.
Well, thank you. I'd like to remind our audience that you can go ahead and type questions into our question panel here on the GoToWebinar control panel. I'm going to start with an overall arching question. I think back, and boy, this is pushing 20 years ago. I was a neophyte in this topic, and I convinced my dad to buy some class 3 futures, and then the market went higher. I mean, we locked them in at a price we could make money on our dairy farm, but then the market went higher, and my dad just lamented that he left all this upside in the market. And obviously the tools have changed here. Let's start with a really basic question, though, and this is what Dad and I had a discussion with over a couple beers one night. Why are we managing risk? What would you say to a farmer who's hesitant on entering into any kind of risk management? Or my dad at that point was like, I ain't doing this again. Well, we came around on that, but it took a little while. Maybe Tiffany, do you want to start with that one?
Sure. I think actually Bill sort of said it in his rundown. Look, nobody likes leaving any amount of money on the table. We're all human. That's just human nature. But I would say leaving a little bit on the table is not what takes you out of business, just like Bill said. It's those down cycles that, those are the ones that take folks out of business. And that's what you need to protect the margin, obviously. But you need to reduce the variability or volatility because it's those down cycles you cannot go through, particularly if the markets fall and stay there for a long length of time. And look, there are tools now. If that is something you can just simply not digest, and there are a lot of folks out there, you can do DMC, you can do DRP, you can buy put options. there are things to do if you want to leave the upside. Don't dismiss risk management. There are ways to get around those concerns if that's something that's overarching for your family.
Bill, would you like to add anything in that regard?
I think Tiffany captured my attitude pretty well. I like analogies, and people that are as old as me, maybe who grew up in the Midwest, will recognize the difference between Harmon Killebrew and Rod Carew, right? One guy is about home runs and strikeouts, and one guy gets on base every day. Both Hall of Famers. So if you're built for that sort of tyranny of working all year for nothing and then cleaning up in a different year, that's fine. I like to get on base every time, and this is a way to do it. And really watching producers I've worked for and just paying attention to the industry in general, it is heartbreaking to see a very capable producer who has gotten up and worked hard be wiped out in one of these backdrafts. We don't, in the industry, generally keep so much dry powder in our liquidity state or our balance sheets that we can take $5 of negative cash flow for a year, as in 2009. And it seems a little odd to me that farmers would be happy to insure their haystacks every year, but still be happy if there was no fire. And that's the way I look at risk management, especially the modern tools like DRP. You pay a small premium, you actually hope it doesn't pay. But when it does, it can be the difference between life and death. When, we've just looked at a milk price swing between $10 and $25. There was no guarantee when this pandemic started that we weren't stuck with 10 for a while. And burning $6 a hundredweight for an extended period of time is not going to leave very many people survivable. And even if you survive, it just took out 6 years of hard work. I mean, in this business, at least in Western dairies, making $1 a year is a pretty good deal. And to give that up in 1 year because I couldn't stomach insurance that didn't pay out, it doesn't. I appreciate a range of perspectives on this, but that doesn't work for me. I want to win. I want to get on base. And we have found it possible for every year and every quarter of the last 20 years to be profitable. And as an example of how comfortable we are, I couldn't tell you over those 20 years if we got paid more or less than our neighbors. What I can tell you, and all that matters to me, is that we were profitable in every quarter because risk management tools offered us an opportunity to do that. This is a long run. If I just make $10 every day over a career, that's good enough.
Chris, we've talked some, and Bill and Tiffany, those are very thoughtful answers. Chris, you've looked at this a long time. Why do you think farmers, especially in the dairy group, are just more comfortable on the crop side, prepaying feed inputs, or, really, there's a lot of hedging strategies that have been done on that side, but they kind of let their milk price flap in the wind. What do you think about that as an economist who's worked with a number of students and talked about this topic?
Yeah, it's a good point, Corey. I think, one is that there was a time when I was a kid when milk prices were stable and adequate most of the time because of the situation the industry was in. We were not in international markets, and we just didn't have the volatility. I mean, it's just a matter of fact that there wasn't the variation of volatility in milk prices back in, say, the 1980s, like we're talking about since 1995 on, when the government has gotten more out and let the markets work there. I think a lot of the feed price risk is also driven by tax management strategies, right? So, and that has, also experience drives, how people use it. I think you made a good point, Corey, when you asked that, when you were talking about your experience when you were younger with your dad. Regret is a powerful emotion. And, I think a lot of people tend to focus on regret because of things they did and not notice the regrets that they maybe should have because of things they didn't do. And Bill made a really good point earlier. about consistency. And to me, that's one of the real keys to this whole set of risk management decisions, is having a well thought out plan that you came about without the emotion involved in it, and then being consistent on how you apply it. Was it a few weeks ago on this podcast or webinar was it Gordy that said nobody ever went broke locking in a profit? It's a good thing to remember.
We're getting a number of questions on one of the poll questions, and the poll questions I pretty much write to help set the stage for our webcast here. And a number of people are asking about that 36% figure of farm income being through government programs. You can Google that. Again, the information came from the University of Missouri's Food and Agricultural Policy Research Institute. The acronym in those of us that follow this is FAPRI, F-A-P-R-I. But the information can be found on their website, and publications such as Forbes even announced that. So the window they're looking at is 2020. It's a projection because we're still in 2020, but it would be all farm income. So, I mean, that would be balancing out grain and wheat and soybeans and dairy and cattle. And that would be the highest number since 2011. So we'll take that answer there, and you guys can do a little bit more research, but I trust both those organizations on that. This is a question specifically for Bill from a dairy farm person that watches this broadcast regularly. Bill, what trades are you looking at in the next 3 months, in the next 6 months? And so that's the big question there, but then he follows up and asks, we could see another shutdown which affected overall sales, but adds class 4 negatives that increase the negative PPD here. And I think we're gonna, so let's look at what you're going to do here, and then we're gonna come up with that question we talked about in pre-broadcast mode from the Iowa Dairyman, because I think they're hitched together here. So what trades are you looking at your farm or risk mitigation?
Well, yesterday was risk management day, so it's fresh in my mind. And one of the comments I make is 6 days a week, we try to guess at future prices. And on Tuesdays, we make money. So, we're always out there a ways, as long as the market has presented us opportunities. So we weren't doing much on the front end. Q4 of 20 has been handled for a long time, as well as the first 2 quarters of 21. I've become very concerned about 21 from the standpoint that the market has received signals that are sort of artifacts that may or may not remain. Some money has been injected into our market that has encouraged an expansion of supply. And today's political uncertainty is a reminder of the economic uncertainty of whether that remains or not. So if you take the combination of a market signal to expand supply from external inputs, central planners, coupled with the pandemic and the uncertainty of when and how it ends, 21 could be very risky. And while Q3 and Q4 are sort of 50 percentile-ish prices, it is compelling for us to think about protecting those as Plan B coverage. We have what we call Plan A coverage, where we have a risk management policy that triggers an automatic action at a specific level of profit for our company. So when we can get into double-digit returns on invested capital, that milk is sold, and it is sold. So if that's $18 milk and $4 corn that provides us that return on investment, the milk is just sold. If we get into more moderate profit or even potential losses, but are still concerned, we use Plan B coverage. And I think DRP is an excellent example of Plan B coverage, where I would like a better scenario, but I really don't want a worse scenario. So for 25 cents in a low volatility environment, 40 cents in a high volatility environment where time is long, we will pay 40 cents to protect us from a loss of $5. So yesterday's action was to add to our current position in Q3 and Q4 using DRP, with the expectation that we can adjust those protection levels using derivatives, futures and options, as time goes by and presents better opportunities. So now we have assured it can't get worse than this. We have ample opportunity to access opportunities for it to get better than this. And those levels, I think both classes of milk in Q3 and Q4 are in the 16s. That's a pretty, I mean, if I was to guess an average price over the next 10 years, it's a pretty reasonable price. It's not 25, but we can make a living there. And that was our move yesterday, is to protect our ability to make a living in the last half of 2021. Minor adjustments up front. In November, in our view, current cash cheese price calculates to something higher than the November Class 3 futures price. So we went ahead and absorbed a $5 or $6 loss on Class 3 milk to get it off the books. We were also at the time capturing a $4 or $5 benefit in Class 4 milk. And again, I'm not a home run hitter. November worked out very well for us. Sure could have been better, but I don't lose sleep over that. I do like to sleep well. And the positions we took yesterday, along with the others, helped me sleep well.
Tiffany, before we go to the, we're going to inject this question that came in here. And I think the audience member, I'm going to change one word here. And if he's not happy with the answer or the question I ask, he can chime in here. But I'm going to edit his question to say, what percentage of milk would you say should go into risk management? What percent of your milk production should you do? I know some of the programs, obviously DMC has a cap, DRP has a cap, I believe, but why don't you talk a little bit about that?
Yeah, if you're thinking DMC and you're under about 225 cows is our estimate, 100% of your milk. I think that's an easy answer. If you're larger than that, I would say, there's no silver bullet, but we are seeing producers take a larger percent of their volume just as we look forward into 2021. I would say particularly via the DRP program, folks they're going up to 100%. I think in most cases, there may be some budget constraints that are keeping volumes a little bit lower than that. But given that they're just floors, and if folks can do it within a budget or premium they're comfortable with, they're taking a large proportion. So I don't know that there's a perfect answer, across all dairies. That's a very individual decision, based on what the market offers you, what budget you're looking at, what margin you need. But I would say seeing a larger proportion this coming year for sure.
Another form of risk management is cash on hand. And so this question, we're going to go to Chris and Bill. How much cash per cow should a dairy producer have in the checkbook or money market for the unpredictable?
Okay, well, I'll take a shot at it. That depends on the farm situation as far as, I actually we usually would track working capital more, which is not necessarily cash. It's cash, but also things that can easily be converted to cash. So you're thinking about inventories and things of that nature. And, you're wanting to see that the current ratio which is current assets divided by current liabilities, be about 2 or above. And then keeping in mind that if we're thinking about working capital, usually we're looking at about having 3 months worth of working capital. And keeping in mind that there's a cost to having too much liquidity too, right? Not a problem that we've had the last few years in the dairy industry. But, if you have a lot of working capital sitting around, that's money that might be invested in somewhere longer term to generate a return.
Yeah, what a great question relative to our point of view, because the answer, if you think about it, depends how much cash should I hold in reserve, depends on how much uncertainty there is in the future. And one of the most compelling reasons to manage that risk in the future is to hold less cash and keep that cash working. So if I have taken all of the uncertainty out of the next 12 months and there's margin being created during those 12 months, why would I need to hold any cash? If you are rolling the dice and those dice could turn up -$5, I think Chris's guideline of 3 months of working capital is reasonable, but it won't be enough in the case of negative $5 of cash flow. And, I'm not making up impossible scenarios. I'm talking about scenarios we have seen in my career. So how much cash you hold depends how much risk remains in your business. And while we're on the subject of cash, another reason to manage risk forward, 2 reasons really is, many of us access debt to grow our business. I've never understood how you can walk into a bank and say, I want to borrow money, but I don't know how this turns out. So managing risk in the future gives you a better answer to the banker, has given us good access to capital and good cost of capital. If you have repeatable earnings and a projection that can be trusted, I think the bank's going to be on your side. And if your history is being all over the board, then they have to withhold some cash in their system to protect variable ability of a producer to repay them.
Thank you, Bill. We had a question come in. Can this happen again? And I'll take that, can COVID-19 happen again? We didn't know when the 2008, 2009 recession would hit in the credit situation. We didn't know that China would get African swine fever and cut their whey imports down to near zero because they're the largest hog herd in the world went away, really, and they're rebuilding now. So you have to prepare for these scenarios that just change things on a dime. We had a dairyman ask this question ahead of the broadcast here, and all those listening, you can do that. There's a function in the meeting announcements for DairyLivestream that you can send questions in ahead of time. So this is really a market question here, and he's talking specific about his dairy. I asked a question like this: what are some risk management options for a farmer not in a cheese market? And we'll dig a little deeper into his farm's example here, but that's really the big question. What are some of the risk management options for a farmer not in a cheese market? As a working example, received a more detailed form of this question, again from the Iowa Dairyman. What are the options if you're not in the cheese market? Please consider these circumstances. Nearly all the cheese plants depooled this summer. Class 1 prices changed. They were not as high due to the market shift because we went from higher of to the average of class 3 and 4 plus 74 cents. And obviously class 4 was not doing so hot and still isn't compared to class 3. And then on his farm, he sold 10% of his milk for $17, and the milk market, class 3, went to 24. But then we had this negative PPD, producer price differential, on his farm that pushed $9. And he laments that, hey, if I would have sold all my milk in the class 3, I might not have survived. Big question. We'll come back to this and say, what are some risk management options for a farmer not in a cheese market? And Tiffany, I think you look like you want to grab that one first.
Sure. I think Bill and I can both address that. We both sit in regions where utilization of class 3 and class 4 are, close to 50-50. So lots of experience there. It is vital that when you deploy a risk management strategy, you're looking at how your milk price is determined. And if class 4 is an influence in your milk price, you have to manage that risk along with class 3. So the worst outcomes I've seen are instances where, both of those markets influence your milk price, but everybody, puts all of their milk, say, on the class 3 market, leaving class 4 completely open. Just looking back at this year, and again, I'll go back to DRP just because it's where we've seen the most involvement here. It does not solve for negative PPT, but I can say those that did manage class 4 by taking out class 4 policies, and this would hold true in the futures and options markets as well, saw significant payouts on those policies that really helped fill the gaps of those negative PPDs, if not entirely, a large proportion. So if you're managing your risk, taking into account everything that drives your milk price, that will most certainly address that concern quite a bit.
Bill? Bill, you might be muted again. Sorry.
I'm good at that. Yeah, as Tiffany said, I am also in a federal market order that has 3-4 spread price risk, which can cause a lot of gyration in your basis, where basis is how your milk price is determined. And I will say that you can't perfect knowing your basis on a moment by moment snapshot. But if you're in a federal order, especially, you can approximate it very well over time. And one of the things about risk management strategies that makes the most sense to me is if you're going to do it, stay in the game, because that variation that may leave you with an unexpected price in this direction this month will wash out over time. So stay in the game. Basis is very predictable. Your milk price is very predictable over time, not moment to moment. So we just stay in it for a long time. And again, another plug, because we manage margins, the firm we work with in terms of protecting our business is really a technology company. Very complex set of software that not only looks at what has happened, but allows you to project what will happen. So for this particular producer who has had this experience, it would be very useful to go into that software and do what if. And that what if will cover both, if he's in futures and options, how much margin will be required of him during this planning period, and what is the net effect on the farm of a range of price scenarios. You can plug in a change in class 3, a change in class 4. It will show you your margin requirement. They call it a capital monitor. And it will show you what the final outcome is on your farm over that range of scenarios that you choose to look at. And I do think managing risk is a technology function, and it is not simple. That's why the why to for me is the first hurdle. The how to, there's just excellent aids out there. We can't all be good at everything, and I would manage risk much less well if I was the only one doing it. But you build a team, and that team understands the complexities of the federal order. They learn how your milk price is made up, and they help you through this, and that's what we pay them for.
Chris, anything to add there?
No, I think those are good answers. I think, for this producer, and as, historically, we used to maybe not be able to work in class 4 so much because of liquidity issues and volume. And one thing about DRP and some of the other tools is you don't have to worry about that anymore. You can, pick your combinations of 3 and 4 and weight it the way you want, and you don't have to worry about whether that trade's actually going to get made in that situation. So that's a nice thing about these new tools that are available.
And as a reminder to our audience, many of you know this, but I always feel that there's people new in our industry. Class 3 is predominantly the cheese market. Class 4 is heavily weighted on whey, and the whey products, almost half of those get exported, and then and butter is in that category too. The thing I'd add to this here, none of us can be masters of everything. I have a full-time job here as editor of Hoard's Dairyman. My dad suddenly died here a year ago, and now I'm running a 400-acre farm, and I have to rely on people that are, I get good teammates, I get good advisors, people that are smarter than me, and they can be smarter on machinery, they can be smarter in risk management, they could be smarter on picking the right seed variety. And while I'm still in charge of my own journey, I have to rely on some of these people to help me out along the way, or I'm going to get in the ditch and I'm never going to get out. So it's not, be ready to ask for help. So I had a couple people nodding their heads the wrong way here. So Jeff, what category is class 3 or weigh in? Is it 3 or 4? I might have misspoken there.
3.
It's 3. All right. Sorry about that. It is class 3. I want to stand corrected. Thank you for the audience members who chimed in on that one right away. I definitely appreciate that. This is an overarching question, and I think this is how we're going to end the webcast here today. Obviously, we started out the webcast talking about the political election, and some of these programs are in the Farm Bill. In understanding the benefits of DMC, Dairy Margin Coverage Program, and DRP, Dairy Revenue Protection, is there any concern about the long-term availability and viability of these programs? Are we banking too much on these programs as an issue? I'll start out with that. Let's use the tools available right now, and if they're working, let's get to the Capital Beltway and say, hey, these are working and we need them. But that's a pretty simple answer here. But Tiffany, you've worked in this field for 2 decades now. What are you thinking in that area?
I think that they, in terms of DMC and DRP, they have been so effective, and we're seeing increased participation. I think, the numbers in themselves should solidify their existence. And I think there's a lot of people working hard on continuing to improve those programs, right? We saw some great improvements to DMC the last couple of years roll out. And I'm encouraged to think there might be some more in the future. Certainly DRP, it's not perfect. There's a couple holes that we need to work on, but I know people are doing that. So I can't really forecast the outcome, but I think, if anybody's paying attention, they're viable. People are using them. Participation is increasing. So I'm encouraged they'll stick around.
Bill?
Yeah. One could certainly imagine in a year like this where FAPRI says 36% of net farm income came from programs, that there may be a lull in the appetite for those programs. And I don't, I look for all kinds of ways to sleep well. And in this regard, the way I sleep well is there are adequate tools in the private sector to manage risk. And it is in the interest of both people like me who sell milk and people who buy milk, commercial end users, to know the future. We will always find a way to get together, whether it's a government program or in the private sector. Both of us need to know our future. So we can sit here and lament that, I don't know what my milk price will be. They're in the same situation. We have a little family brand that sells cheese, and how many calls we got this summer from people who buy cheese pulling their hair out. How do we price a menu item when we don't know if the cheese on that item will be $1 or $3? Can you help us? Well, yes. So this can be producer to buyer. It can be futures and options. Those are all private tools, and they will remain, because that's what markets like. They like certainty. They like price discovery. The government programs are nice. I think they are less reliable in terms of a whole career. So I use them when they're available, but I make sure that I know how to access private market price discovery and protection mechanisms as well. And I don't expect this election will change the course of my business over the next 10 years. And again, that gives me a good way to go to sleep. That's what I live for. I sleep well.
Chris, any final comments in that regard?
I think it's definitely the ad hoc payments. So the coronavirus food assistance payments, which have been very large this year. The food box purchases, which were a topic of a different webinar, which have been really important in holding up demand and price for dairy products. Those ad hoc type payments, those long run ad hoc payments come and go. That's why we call them ad hoc. The Dairy Margin Coverage Program being now part of the baseline, and the expenditures being part of the baseline, means it was, to the extent that they want to continue it, that'll be much easier to continue than before we had a baseline, right? But the politics and the budget situation are going to matter. Who the leadership are in Congress, who the president is, matters to some extent, although probably not as much as it used to. And then the budget situation, if we get in a situation where they start looking for cuts, then there'll be some politics between commodities. But it certainly helps to be part of the baseline.
And the baseline is the spending level in Congress. So with that, we are going to wrap up here, where our next Dairy Livestream webcast is going to be November 18th. It's a Wednesday, 11 o'clock Central Standard Time. And I'm Corey Geiger, your moderator and host for Dairy Livestream, I'd like to thank Chris Wolf from Cornell University, Bill Maverin from Sunny Dean Ranch, and Tiffany La Mendola from Blimling and Associates for being part of our webcast today. It means a lot. And thank you so much and have a great day, everyone.
Thank you.